Yo, what's going on? Welcome into today's banger video. Today, we're going to be getting into the strategy that gets me consistent $20,000 months, sometimes $30,000 months, and I'm looking to scale even harder for the next couple months and get my goal of $50,000 months. But this is a strategy that has gotten me consistent $20,000 months. I post my payouts on my story on Instagram, so go drop a follow on Instagram. Leaving it right here on the screen. Before we do get in the video, I released a completely free trading course go over my strategy, more in depth on this. It goes over every single concept in depth. It's for extra help, but it's completely free. It's 6 hours worth of information, extra classes in there. I leaked some of my old Inner Circle classes in there as well to help you guys out. But yeah, it's the first thing in the description if you guys would like that. Now let's go ahead and get to the actual strategy video. Let's go. All right, so my GS strategy that gets me $20,000 months. Okay, you're probably wondering, what does GS stand for? That's my initials, gang. That's part of my name. So I used to have it called the Axis model, which was kind of like the ideal name for it. But some people were getting confused. They thought it wasn't my model. They thought it was somebody else's because the name was different. So let's just keep it simple, the GS model from now on, keeping everything kind of in the same place. Now, let's go ahead and get into the actual fundamentals. There's around kind of 3 to 4 concepts you have to know specifically that I'll go more in depth in. So starting off here, we have to understand AMD. What is AMD? You probably heard this. You've also heard the term power of 3 before. That is the stages of market cycles. So AMD is accumulation, manipulation, and distribution. What does this look like? So right here in the yellow, hold on, let's see. Yeah. Right here in yellow, this is going to be your accumulation. Accumulation looks like sideways movement on a price chart. It looks like highs and lows that are like completely balanced, like they're not breaking. It looks like consolidation. So whenever you hear me say consolidation, that is going to be accumulation. All right. And it's very important that you know you will never, ever, ever trade in accumulation, no matter what. There's no excuses for it. I've not traded in accumulation in the past year. It's so important that you do not do this, okay? So do not trade in this because this is the market's way of accumulating orders, getting people to get stopped out, get their order filled. It's just not a good place to be in because you have no edge on the market. And remember, what makes us profitable traders? We need to have some sort of edge, something that gives us an idea of where the market's going to go. And when you're trading in a perfectly balanced market where we're just ping-ponging up and down, it's completely balanced. There's no edge. You're just 50-50 odds at that point, okay? Now, after we get our accumulation, we now have manipulation. This is basically the most important part because whenever you're looking for manipulation, the market is going to break accumulation. So as you can see right here, with this high right here, we broke out of that accumulation. Now, where do we go? In this case, we're going to go to a specific key level. We're going to break that down more in depth here in a minute, but I'm just kind of giving you guys a framework of how the market moves. So it's going to go from accumulation, so consolidation. It's going to break consolidation and go to a key area. And then from there, it's going to do the exact opposite. So look, we manipulated up right here. Actually, I'm going to see if we can clean this up a little bit. Notice how with this manipulation, the market went up to do it. And then after we manipulated, we sold off lower. And us selling off lower is going to be the distribution. So distribution is always the opposite of manipulation. We are going to be looking to trade primarily in the distribution phase of the market, which makes it extremely easy. So as long as you can identify where were we consolidating, which is extremely easy, where were we going sideways, you can easily find that on the chart, where it looks like a bad time to trade. All you have to do is find that, then look for when we break out of that level, and then start the reversal. That's why this is so easy. You're literally just looking to see where are we going, and that sets in your bias for the day. It's extremely simple. So now that you guys knew that, let's go up here and explain continuations. All right. So what is the framework of a continuation trade? So what are we going to do? We're going to establish market direction. Are we going higher or are we going lower? It seems extremely easy, and that's because it is. Everybody wants to make trading so complicated, and the reason why is because a lot of people just want to sell some overkill course on the shit. It doesn't have to be hard. I'm giving this to you for free. Literally, it's super simple. Are we going higher or are we going lower? So in this example, I hope you guys can tell we're going lower, but we do have these pullbacks. So notice how we had bearish distribution right here. Okay, so notice how we're selling off, and then right here and right here, we start going a little bit higher. So we're catching a market pullback. Where are we pulling back into? Well, first of all, we're rebalancing the bearish distribution, but we're trading into some sort of key level, and the market will do this each time. So we pull back, and then we continue this original bearish distribution, and then we're going to go higher again for a market pullback, and then get further bearish distribution. Now, the reason distributions in general, it needs pullbacks is because the market can't go one direction forever. The market can't just go up and up and up. I remember last week, there's a day where the market literally just went in like one direction off a market open for like 10 minutes straight. All the 1 minute candles were just green. But that doesn't mean on the 30-second there wasn't a down close candle. Okay, so you have to understand, like, the market can't just go one direction forever. You can't only have buyers, you can't only have sellers, because the market has to balance. The entire idea of trading this model is we need to find balance. Okay, so we're looking for, where are we going? We're going to wait for the balance, and we're going to execute off of that balance. Okay, because it's very important. A lot of you guys get stuck in trades where basically you are trading. If you see this bearish distribution, you might want to go, hold on, let me erase some of this stuff. You might want to go short right here. You might want to enter your short position to go lower right here, and the market runs up and stops you out. That's because you're not trading with the pullback. You're just trading an expansion / distribution with no idea of how they properly work. So this is me telling you right now, you're not going to just be randomly shorting or longing a distribution move. You actually need to wait for the market to give you a pullback. Wait for a reason. Don't just jump in on it because of FOMO. You see the market selling off in this case. No, you need to wait for the pullback. Okay, so now that you guys know that, what are we looking for? We are looking to trade the distribution / continuation move by utilizing important pullbacks / manipulations. Okay, so like I just mentioned, pullbacks are manipulations. So whenever we see AMD, okay, there's going to be manipulations. Now you're probably thinking, Gus, you just showed the AMD chart, and the AMD goes accumulation, manipulation, and distribution. But in that previous example where the market was just dumping, we weren't really accumulating. On a lower time frame, we do. So you have to understand, AMD applies on every time frame. On the 1 second, 5 second, 15 second, 1 minute, 1 hour, 1 day, 1 week, 1 month. So a 1 month accumulation might be a 4-hour manipulation. Okay, there might be, like, there's going to be AMDs all inside of different time frames. You just have to keep your, eyes focused on that current time frame that you're trading and what kind of idea you're looking for. So I'm going to show some more examples here in a minute to make this a lot easier to understand. But how are we going to, what are we looking for? What's the most important thing? So the pullback and manipulation almost always trades into a prominent PD array. Okay, the reason I say almost always is because sometimes it'll trade into one that is just like not important. And what I mean by that is like a fair value gap that's already been traded into. I'm going to show some more examples here in a minute, so don't worry. But first, OTE. This is a framework for every trade. What is OTE? Well, right here, utilizing OTE. Okay, first of all, you're going to go here and you're going to take these fib settings. Go ahead and take a screenshot of this video and get this down here. So this is the 1, the 0.62, the 0.5, and 0, 0.705, 0.79 of a trend. These are all fib settings, okay? So OTE is a Fibonacci retracement tool / config that measures the equilibrium of the price range alongside other significant deviations. So 0.5 is going to be that equilibrium right here. And you can even go and mark it out in a different color just to make sure that you can see it easily, because 0.5 is the most important one out of all of these. I would say 0.5 and 7.9. So I'm going to show you guys how to draw this on your chart. So the first thing, bullish OTE is going to look like this. You're going to draw OTE from the low of a trend to the top of a trend. Okay, so it's going to be 1 on the bottom and then 7.9, 7.5, 6.2. So you're basically going to have all the deviations on the lower half. For a bearish one, it's the exact opposite. You're going to have the deviations on the upper half. Okay. Now, from here, now that you understand what OTE is, and I'm going to show you a trade recap from today where I took 2 wins using this and caught over 130 points here in a little bit once I kind of give you guys a full breakdown. But first, you need to make sure OTE lines up. What does that mean? We need to retrace to that 0.5 of the trend. So basically in a scenario like this, say we had the high up here and the low right here, you need to wait. If you're going to target a level above that, you're going to wait for the market to trade below or at 0.5 to then go long for this level. Okay. So before I actually continue this, I want to explain understanding draw and liquidity first, because you need to understand this quickly before we go into the actual entry, because this will not make sense if you don't. So what is draw and liquidity? Draw and liquidity is an area on the chart where you anticipate has a lot of limit order set liquidity. Or in simple terms, if you don't understand all of that yet, which you need to, but if you don't, draw and liquidity is an area where you anticipate the market to hit or be the objective for that session or given time frame, whether that's the 15-minute, the hourly, or the day, okay? Or New York session, London session, Asia session, okay? So from here, what are the best draws on liquidity in the market? Previous day high, previous day low, session highs, session lows, data highs, data lows. I want to see data highs and data lows. I mean CPI, NFP, and PPI. Then swing points, unfilled dailies, 4 hours, and 1 hour fair value gaps. Okay. Make sure to screenshot this and write this down, because I want you to do this every single day. This is all you need to mark. This is the only levels you need to mark on the chart. Okay. And if you do that, I guarantee you'll be successful as long as you follow the rest of the strategy. So you just need to mark these each day. Okay. So the idea here is that we need to find a level where we think the market's going to go. We don't technically need bias. We just need a level where we anticipate the market to reach. Okay. So it's usually almost always going to be one of these. And actually, no, I can say it will be always at least one of those I mentioned. So what do I do with draws on liquidity? Your draw on liquidity will correlate with market structure and distribution. So if you are marking out previous day low and the market is dumping, that's perfect, because it's dumping towards previous day low. So if it's a low, it's going to be below you. And if the market's dumping, your bias, the market structure, is aligning with your draw on liquidity. Your draw on liquidity is here, market's dumping. They align together. Now, it'd be another thing if your draw on liquidity was previous day low and the market was pumping. It's going against it, so it's not really beneficial. You need it to correlate. And if it doesn't, find a different draw on liquidity. That's why there's so many. Swing points are the most versatile because you can find so many of them. Okay. Now, your draw on liquidity will be your take profit / TP for every single trade. There's not going to be an emotional profit amount, just a technical point on the chart that has a high probability chance to get hit or reached. Now, please note, no emotional profit amount. I know a lot of you guys see, I'm up $500, I'm up $1,000, $1,500, blah, blah, blah. I'm going to TP here. That's not how you do it, because that's not going to be successful. You can't really track that data. At the end of the day, you need to be trading in a way where you can track all of this data, so you know that what you're doing is still working and you can see the flaws in your system. Okay. And by you going and taking $500 this day, $700 this day, and your risk to rewards all over the place, it's not going to be easy to understand the stats of your actual strategy. Also, do not take profit at an R multiple. So if you're up 1R, don't just TP because you're up 1R. Don't TP because you're 2 or 5 or 10 or 50. Do it at your draw on liquidity. Okay. So your draw on liquidity will be your take profit for literally every single trade. Okay. Now back to here. What are we looking for? All right. OTE, which is going to be your framework. Have we rebalanced equilibrium? Okay. That's what we're going to establish first. And then what are the key levels around OTE? What is at OTE, above OTE, below OTE? Where are key PD arrays / levels that can manipulate? Okay. So we have a fair value gap, whether that's like a 1 minute, a 5 minute, a 15 minute, a fair value gap, or a swing point, or a key open, like the 18 o'clock open Eastern Standard Time and military time, or the midnight open, 000 on New York time, or an S&T. So you need something to like sponsor that idea. OTE is the framework, but you can't just enter off OTE, because if we go back here, remember, there are like multiple levels. Okay, so you're going to have what? We have 0.5. If you just like randomly, if you're going to go short here, like it can literally just go and like go for all of these and stop you at like 4 times. You need to make sure you're doing the right one. So you have to align OTE with like a fair value gap or a swing point, so you know where it's going. Now, this is very important. I'm going to go ahead and mention this now. We're just going to do it with this bearish OTE trend. If you're in a bearish trend and the market closes above 7.9 and gets fat closures, I'm talking like this is acceptable. Anything over this, no, you're not going to take that trade. Your trend is practically invalid. There is such a slim chance that if the market is going to go lower, it's going to go all the way up here to go lower. It's practically impossible. At that point, it's not worth taking the trade. So everything here is fine, but the second you see something like this, like, bro, get out of that trade. That's not a good trade to be in, okay? Anyways, so now, what is the main idea of this strategy? Sorry, brain fart there. Are we in accumulation, manipulation, and distribution? Super simple. Are we consolidating? If so, I'm not going to trade. Are we manipulating? Okay, I'm not going to trade. Are we distributing? Okay, yes, I'll trade. All right, now that I know we're distributing, are we going higher or lower? Literally look at the chart. Are we going up or down? Okay, let's say we're going lower. Okay, then we're going to find the pullback to the PD array so that fair value gap, liquidity level, key open, SMT, and does that align with OTE? If yes, we're going to find an IFG entry and we're done. Okay, bang, that's all you need. Okay, so how to enter using the model? You're going to find an IFG from the 15-second. Now, you're probably thinking, Gus, what the hell? You're the first person I've ever seen use a 15-second time frame. Well, it's OP, and nobody ever makes, like, I've never seen anybody but me trade on the 15-second. Everybody thinks it's too low a time frame because there's the whole idea of the lower time frame is going to confuse you. Stay with the higher time frame trade. And yes, this is true, but as long as you understand AMD, this is no problem. I've taken successful trades on the 5-second time frame. It's rare I take them, but if there's low risk, sometimes I'll take them as long as it follows this model. Okay? You have to be able to understand the market is the same shit on every time frame. The daily time frame works with this model. The 1 second works for this model because at the end of the day, it's just market algorithm, it's market structure. There's nothing, it's not time frame specific. Okay? Obviously, there's going to be different risks. If you're trading on the daily, your stop loss is probably going to be a couple hundred points. That's probably not the best unless you size down. Okay? Anyways, my cat just jumped up here. But yeah, so find an IVG on the 15-second/5-minute time frame after the market has manipulated a PD array. So that fair value gap, that liquidity level, the key open, the S&T. After this has happened, find the IFVG, but don't exceed the 5-minute. Okay. Now, here is an actual example before we get into the trade I took today or the multiple trades I took today using this model. What are we seeing here, all right? Bearish market structure. We are dumping. So we have established we're going lower. All right. Now, this right here, this swing low, this could be a draw on liquidity because it's a swing low. You could go for this too, but I like going for whatever's highest probability. One of the closer swing points to the most external one is going to be higher probability than that external one, especially when we have such a fat wick like this one. This is a huge wick. We could just use it as a rejection block at the midpoint and bounce from that. I don't want that to happen, so I'm going to go for this right here. It's easier. So we have number one, we've identified bearish market structure. We're dumping. Now, notice how we've drawn OTE from this high right here. Okay, we drew it from this low to that high. So we drew it out. Now we have 0.5 right here. Notice how the market trades up to 0.5 right here. We wick it. And then notice right here, we also have these fair value gaps the market's trading into. All right. Now on this time frame, or on a different time frame, there might be another fair value gap right here. I'm pretty certain there is, but I didn't get in the screenshot. But even if there's not, it doesn't matter because we go 0.5 and then we set in a bearish S&T because remember, right here, SMT is at the bottom right here. SMTs can be used as an entry signal. So, or not an entry signal, but a reason to go and enter the trade. So we have an SMT with this high with ES and that. And then right here, the most important part, this fair value gap gets inversed right here. And that is your entry on this trade. You enter right there. Bang, terrible handwriting with this mouse. So the bearish IVG is your entry. So, and right here, the swing low is your TP. We already kind of went over that. But yeah, it's super simple. Bearish market structure, retrace to 0.5. We rebalance that range, so we're ready to continue. SMT, bearish IFVG entry. target the swing low, which is the draw on liquidity. Super simple. That's the model right there. Super freaking simple. Okay. So yeah, and this all just kind of connects together, and that's literally it. It's so freaking simple. Everybody wants to make trading complicated. I'm giving it to you here as simple as possible. Okay, and if you have questions, feel free to reach out to me on any social medias. I've got a free Discord linked below. I've also got that free course linked below. Okay, go and watch that. It explains every single concept in depth, completely free. I made it to help you. Okay, now let's go into the trade recap of the trades that I took today using this model and caught over 130 points using it. Alrighty guys, so I got the trade recap for today up here. Now, first thing I'm looking at, all right, we're selling off towards market open right here. Market hasn't even opened. It's 7:52 a.m. Eastern Standard Time, and I know we're dumping, and we have this low below us. We did sweep it out, but we're still going lower, dumping lower. So what am I going to do? Okay, and also, hold on, very important, we've still gone and continued dumping on the higher time frame, so I'm following that bias. Now, we take the fib from the high. We're going to drag it all the way down to this low right here. Okay, now I've done that. We correct it. So I know that 0.5 is going to be right here of that trend. But also, when we trade down on a lower time frame, we also have this trend right here. That'll also be what we're looking for manipulation. So first of all, right here on this trend right here, this downtrend, we had this right here. We had an immediate top tick kind of rejection off of 0.5, but we know we're not going to take it just off of that. And we had a unfilled fair value gap right here as our confirmation, or not confirmation, but sorry, confluence. Now let's go to actual market open here, so I can show you what I was looking for. So this right here, this dollar sign is the 15-minute unfilled fair value gap. All right, so we had one right here at a little over 6.2 and under 7.05. So that was my draw on liquidity going into market open, meaning I wanted to catch longs towards this, but I didn't end up getting longs. So you're going to see what I did instead. So right here, notice how we're about to pump for the high. Bang. All right, we pumped for the high. Now, right here, what do we see? We've manipulated that 15-minute fair value gap. And on the higher time frame, we've still not gotten closures above 7.9. So we've traded into a PD array over 0.5, and on the higher time frame, over 0.5 as well. We traded over 6.2 as well. So we've traded deep past equilibrium. We've definitely rebalanced the market. And now we've manipulated that 15-minute unfilled fair value gap. Perfect. Now, notice how we have this fair value gap right here. And then notice how this gets closed below. All right. That was my sign. I went ahead and clicked sell. Put my take profit over, or sorry, my stop loss over that high. And then TP'd these swing points right here. Super simple setup. Actually went slightly above that just in case. And then look, bang. Then 30 seconds straight hit because it was right at market open. Market open is used to distribute or manipulate. So this is very important. I'm about to put you guys on game. If you watch to this point, you're about to get some crazy game. All right. First thing, the market open has two functions. It's either to manipulate the market or to distribute. If the market manipulates a level before market open, then market open will distribute. If the market hasn't manipulated before market open, then market open will be manipulation and then distribution. Okay, so right here, what time is this? 9:25, 9:26. We manipulate the unfilled 15-minute and then right at open, inversion, dump. Super freaking simple. Okay, now, all right, we entered off of the IFEG targeting our draw on liquidity. Okay, so all we have to do is establish we're going lower and find a swing point. Cool. So now the market's continuing to dump. And let's just play it out a little bit more. We're catching resistance here at a 15-minute unfilled, or a 5 minutes, one of those. Doesn't really matter too much. But notice how right here, we also have this 1-minute fair value gap. So I'm just going to hide that real quick. There's a 1-minute fair value gap right here. So we're going to wait for that to get tagged into. Bang. Right there. Now, let's go to, I started at the 30-second, and I'm trying to look for fair value gaps on the way down. But notice how we don't see any. We also have this gap right here above us, so we're keeping that in mind. But let's just kind of see we've already wicked it. All right, so I haven't got my entry yet. And notice how we don't see anything yet. I'm going to go to the 15 second, see if we find a fair value gap, and bang. Fair value gap right here. I'm not traded into either, so it's higher probability. I'm going to wait for this to get a close below. So we've manipulated, in this case, we manipulated a 1 minute and a 30 second. And now, keep in mind, we're also trading on the right side of OTE for the smaller range. We're just trading in ranges, guys. We've traded over 0.5 and we've basically tapped 6.2. I don't think we did. My fib might be off by like 1 point, but most importantly, we traded over 0.5, so it's okay to go short. We've rebalanced that range. We've traded into 2 PD arrays, which are the fair value gaps. Now we're going to wait for an inversion on this. Bang. Now I'm going to go short again with a stop loss at the high. This is wrong. It was at the high. Now we're going to target down here, which was literally, I believe, is a fair value gap, or it was this swing point. I think they aligned together, but we're literally just going to target another draw on liquidity. And bang. That's simple. It's the same. We did the same thing for both trades, just on different like scales. This is the 15 second, the other was a 1 minute. On the 15 second here, we can even identify a market structure shift going lower. Okay, so it's that simple. All right. All you have to do is find the higher time frame trend, measure the rebalance with OTE, find out did we manipulate a specific level. If we did, good to go. You look for a fair value gap to get inverse. Once it's inversed, and then you enter the trade. So super freaking simple. That's the entire model. That's the GS model right there that helps me get consistent $20,000 months. If you have any questions, feel free to reach out. Once again, it's a completely free course linked below. And yeah, I will see you guys in the next video. Y'all take care and make sure to take notes. Peace.